Join us for the ETF.com Awards on May 2nd in New York City to honor and celebrate innovation, excellence, and growth in the ETF industry. With an impressive panel of expert judges, a record number of nominees, and more than 200 of the most influential players in the ETF space, this is one event you won't want to miss. Reserve your seat today at awards.etf.com.
Hello, and welcome to Exchange Traded Fridays, our weekly news roundup from ETF.com. I'm Daria Solovieva, the managing editor of ETF.com, and with me is my colleague and senior analyst, Sumit. Hi, Sumit.
Hey, Daria, how's it going?
Good. Lots of interesting stories out today at ETF.com, and we wanted to kick things off with just kind of asking about the significance of the jobs report this week for ETF investors and what everyone should look out for.
It's significant because, right, we just got the banking turmoil in regional banks in March, right? So the jobs data that we got on Friday is telling us, did that banking turmoil affect the economy in a significant way? And in particular, the Fed is interested to know whether wage growth is also slowing down, right? This is a big part of inflation. Wage growth in the service sector has been fueling high inflation. If we can see that wage growth start to tick down, then that bodes well in terms of the Fed's interest rate hikes are working to bring inflation down. So it's twofold. We want to know whether the banking turmoil has affected the jobs market in a significant way. Hopefully not. And we also want to know that wage growth is starting to slow. And if it is, that's a good thing because the Fed's interest rate hikes have helped to bring inflation down.
For sure. Lots to watch there and a few details to parse through. And you had a couple of interesting articles out this week. One of them is on why U.S. investors are shunning U.S. stock ETFs this year. What have you found?
Yeah, this was a super interesting story because we look at flows every day, every week, every month here at ETF.com, and we generally see a steady flow of money go into ETFs of all types, right? And particularly US equity ETFs. This is usually the category that takes the lion's share of new money that comes into ETFs. But if you look at the flows data for Q1, we saw that investors actually pulled a couple $billion out of US stocks during the quarter. Mm-hmm. And in this article, I kind of wondered, why is that? And ultimately, my theory is that investors are extremely pessimistic about US stocks at the same time that risk-free interest rates are at 15-year highs. So in other words, even when investors are pessimistic about stocks, over the last 3, 4, 5 years, we've seen bouts of pessimism, but they've still reluctantly put money into the market. But this year, they have a viable alternative that they can feel good about. Treasury bond ETFs, as well as money market funds, which are offering yields of around 5%. And if you look at the flows into money market funds, they're just absolutely massive, $500 billion since the start of the year. And that essentially tells you how much demand there is for guaranteed yield. And stock ETFs have kind of been on the losing end of that. Even though they perform well, investors just don't want to take the risk in this environment when they can get 5% sitting in a money market fund or an ultra short bond ETF.
Got it. Yeah. And you also have a piece out on AI taking over the world and make an interesting argument that we've seen almost every sector disrupted with the AI revolution at an unprecedented scale. And the argument that you're making that it makes sense for investors to gain exposure to AI through ETFs. Why exchange traded funds such a good structure for gaining exposure to this fast-moving sector?
Yeah, so Daria, you and I, and I'm sure everyone listening knows just how rapid the advancements in AI have been over just the past several months, right? It seems like nobody outside of tech was talking about AI. Now suddenly everyone's talking about it, and not only talking about it, but using it. Chat GPT, Midjourney, Stable Diffusion, you name it. These are extremely impressive products, and they kind of give us a glimpse at the potential that AI has over the next several years. So given that, how would an investor go about capitalizing on the growth in this theme? Well, one way to do it would be to buy individual stocks, but that's always a tricky thing. You have to worry about buying not only the right stocks, but at the right price. 2022's tech meltdown taught us that valuation very much matters. And while you could still get burned by buying an ETF when valuations are high across an entire industry, we've seen many ETFs implode in 2022. But the diversification that you get with ETFs gives you a degree of safety that you usually don't get when you buy one stock or just a handful of stocks. So that's why I think ETFs could be a good way to play the AI theme. And I mentioned in the story a couple options. You have things like the iShares US Technology ETF, ticker symbol IYW. This fund's unique because it holds all the big mega cap tech companies that are investing heavily in AI: Microsoft, Alphabet, Meta, NVIDIA, etc. And you don't see that as often in tech ETFs anymore because since the changes that were made to the global industry classification standard, some of the mega caps moved into the communication services sector while others remained in tech. With this ETF, they're all there together. And another way to go about investing in AI that I mentioned in the story is through more niche type of AI ETFs. These funds, they usually combine AI with robotics to create more of a broader autonomous tech type of ETF. So you have funds like BOTZ, BOTZ, Robo, ARCQ, IRBO, and ROBT. And the thing about these ETFs is you have to look closely under the hood to see what strategies and what stocks they own because they vary quite a bit.
Definitely lots of options for investors and super interesting structures for gaining exposure to AI. We'll link to these stories in the show notes, and you can find, before we turn over to our guests today, you can find these and other stories on ETF.com as well. And today we'd like to welcome Ryan Jackson, research analyst at Morningstar. Welcome, Ryan.
Yeah, thank you guys for having me. It's been a little while since the last time I was on. I was worried I was going to be a one and done. So I'm thrilled to be back.
Yes, I should say welcome back to our show. It's great to have you back. So in terms of your first quarter report that was published earlier this week, is there anything that stood out to you or surprised you in particular?
Yeah, so it was a really interesting first quarter in the world of ETF flows. Overall, U.S. exchange traded funds collected about $77 billion in the first quarter, continuing to pull in money, but pretty unique under the surface what we were seeing in the sense that bond ETFs really took over the mantle and looked like they're in, whereas U.S. stock ETFs, which tend to be the bread and butter of ETF investors, kind of look like they're falling out of favor. Starting in the bond world, we saw ultra short bond funds starting out very sexy with the most conservative cash-like portfolios you can find, pulled in about $16 billion in the first quarter. That led all Morningstar categories. And like I said, these are your very safe, very short-term bond portfolios. Their average duration tends to be only a few months, but you can kind of see the case for why investors would move there, just given that the yield on the 3-month Treasury bill was at its highest level since before the global financial crisis. So you can get that attractive yield, get compensated handsomely for really not taking on much risk. Similarly, in the conservative bond world, we saw the long-term government bond category pick up about $15 billion in the first quarter. That's really an extension of a trend that we saw starting to brew last year. These funds over the past 12 months have grown at an 84% organic growth rate. So that means from investor flows alone. I think what we're seeing are some investors continuing to want to lock in some of these longer term yields while they can. Some were a little bit early on that trade. We saw a lot of investors start to file in last year before yields really hit their peak. But for those that were able to hop in earlier this year, I think it was a pretty timely trade for them. So we're seeing that really conservative stance, and you kind of get it on the other end too, where we saw high yield bond funds actually suffer about $8.5 billion of outflows. These are riskier, a lot of times highly corporate bonds. So I think that's a testament to this really conservative mindset that a lot of ETF investors and a lot of bond ETF investors in particular started to take.
Yeah, that's interesting. And the divergence that you mentioned between the stock and bond ETFs in the first quarter, do you see that continuing into going into the second quarter now?
It's tough to say because for so long, US stock ETFs have been the old reliable for ETF investors. That's where you've got your big S&P 500 funds, your total market funds. But in the first quarter, even though overall stock ETFs picked up about $22 billion of inflows, that's because there were $30 billion of inflows into international stock funds. So that headline number can be a little misleading, because when it comes to US equity strategies, we saw them lose about $5 billion in the first quarter. Their first quarter of outflows since 2016. When I think about the culprits here, I think you need to start with large value funds. This category pulled in about $80 billion in 2022, then follow that up in the first quarter this year with $7 billion of outflows, which is their worst quarter to date. I think maybe some investors got a little overexcited about these dividend strategies, these deep value strategies that handled the bear market last year better than most. They're starting to kind of pull back on that enthusiasm a little bit. And then even in the world of large blend funds, I call those old reliable, where they're holding your S&P 500s, your just portfolio staples. But we even saw these strategies lose about $1 billion. I suspect maybe investors are looking around, and after such a long period of there is no alternative to stocks, they're turning to places like ultra short bonds, government bonds, because that attractive yield is available elsewhere for the first time in quite a while.
Yeah.
And I'm sorry, Daria, but on the stock ETF flows, I know Sumit wrote about that a little bit this week. I'd be curious if there's anything else that I may have missed or you wanted to chime in on.
Yeah, that's interesting, right? I think you hit on it, right? You're talking about there is no alternative for so many years, and now there is an alternative, right? And particularly, we've seen, as I wrote in this article earlier this week, $450 billion go into money market funds. That's just incredible. That's a 10% increase in money market fund assets since the start of the year. They have something like $5 trillion now. And if you look at these funds, they're offering almost 5% yield, close to risk-free. And that just seems super attractive in an environment where stock market is down from the highs, but it's not down all that much, right? The S&P 500 something like 16% off the high. So there's not necessarily deep value in the stock market. At the same time, we have inflation still really high. We have the banking crisis going on with regard to regional banks. So I think investors are just super pessimistic about stocks right now, if you look at the investor sentiment surveys. And at the same time, they finally have an alternative they can turn to that's offering, solid yields finally after, 10, 15 years. So I think it's a combination of those things.
Yeah, that's an interesting point, Sumit. And I think that we're seeing a lot of interesting and unique dynamics happening this year. You mentioned international ETFs, Ryan, and kind of the question I had for you was why we've seen them perform so well in terms of, inflows. They've absorbed 30 billion in the first quarter, right? And then especially kind of in the context of what's going on with the US equity ETFs, we've seen some of that trend emerge late last year, but it seems to be one of the big themes going into this year. Why do you think that the international ETFs in particular perform so well?
Yeah, it's a great question, Daria, and honestly one that I've been trying to sort out myself. It has been a pretty concentrated rise for international stock ETFs in terms of the categories. You've got Europe stocks actually pulling in a ton of money so far this year. That's kind of been concentrated in one portfolio in JP Morgan. Beta Builders Europe ETF, that's BBEU is the ticker, is pulled in about $6 billion in the first quarter. I've also seen the foreign large blend and diversified emerging markets categories pull in quite a bit of money as well. These kind of house a lot of broad index funds that will give you exposure to, a wide range of markets from Europe to your kind of MSCI ACWI, these global portfolios. But outside of that, those three categories, there hasn't been a ton of activity. Not a ton of country-specific flows or picking out certain niches in the market. So as far as what is actually driving it, I think as Sumit touched on, pessimism in the US could be a factor where, folks still want to get some of their international exposure or their stock exposure, but prefer to get it, outside of an economy that's kind of been riddled with inflation and now a banking crisis. Those aren't uniquely US issues, but I think they're ones that feel like they're hitting a little bit closer to home here stateside. So that could be pushing it, but I'd be surprised, to get back to your original question, if flows into US equity funds were down for long, just because they're so ingrained in the ETF world and so many investors' portfolios. It would be surprising to me if people abandon them altogether.
Mm-hmm. I mean, certainly there is a lot of sources of uncertainty when it comes to recessionary fears and job report that this week, and others areas of uncertainty that seem to be compounding. In terms of the sustainable ETFs, that's our record. We've covered this extensively for ETF.com in terms of
Mhm.
6 billion exit in the first quarter. Do you see this as sort of a reckoning moment for ESG? And then if we, without getting into much of a methodology, if you could walk us through as well how you think about sustainable ETFs on Morningstar in terms of your methodology.
Sure. Do I think they're a reckoning? I think is a really interesting way to put it. And I would hit the pause button on that. On the one hand, look, if you kind of look back at quarterly flows into sustainable ETFs going back to late 2020, it's been a pretty steady downward march. I think that's kind of when enthusiasm for these funds peaked, is they tend to lean growth a little bit. And at the end of 2020 and early 2021, growth stocks were doing extremely well. So I like to think there was some sort of performance chasing involved. And then, you see $6 billion of outflows. This quarter is their worst to date by a wide margin. The reason I don't think it's a reckoning necessarily is because I think that $6 billion outflow is a little bit misleading in the sense that pretty much all of it came out of one ETF.
Mm-hmm.
ESGU is the ticker.
Mm-hmm.
And it wasn't necessarily the angry mob had their pitchforks and torches out and decided that they were done with ESGU and ESG in general. It's that this strategy was slotted into BlackRock's target date series, very widely followed model portfolios by a ton of financial advisors. And they swapped in iShares MSCI USA Quality ETF, QUAL, in the place of ESGU. So we saw in one day alone about $4.5 billion change hands from ESGU to QUAL. And I think that kind of left a black eye for sustainable ETFs as a whole when you look at the quarterly flow numbers. So even though the trend has been working down that way, I think ESG has come under a lot of pressure. You see it with some institutional money, with a lot of public funds, especially in the southern states, coming out against ESG and against BlackRock specifically. Mm-hmm. I'm still not ready to say that, this is it for ESG and the flows that they attract, because I still think the case is strong, even though their performance has been down a little bit. And I still think they speak to a lot of investors, right? So I don't think a lot of these folks that were pretty convicted in sustainable investing are going to do a 180, a big heel turn after the performance started to slip and certain politicians have spoken out against them. Of course, we'll see, but yeah, I don't think this is going to be, a real turning point that we're seeing right now. I think they'll make their way back. And as far as how we define sustainable ETFs, we've got a methodology paper that lays it all out pretty well. I think intentionality is a big part of it. At the end of the day, what is your investment goal? It's not really going to fly if someone kind of backs into it because they invest in a couple clean energy companies because they think they're trading at attractive multiples or something like that. It's got to be a central part of the overall investment thesis, of the index's purpose, of the active manager's purpose. But it's a pretty nuanced thing that, the folks on our ESG team have done a great job sorting out and have been working on for quite a while.
Mm-hmm. That's fair. And I think even beyond this particular figure being so concentrated in one name, I think we are seeing issuers rethink their methodology or even kind of their alliance with the ESG names and categories, which has been an interesting kind of trend to observe as well. And you mentioned also the banking crisis, the financial crisis that we've seen as being part of the uncertainty and stress. And so the, Spider S&P regional banking ETF carry is down over 28% for the quarter. From your perspective, when you look at the financial sector, is the banking crisis over? How should ETF investors be thinking about this, financial institutions and the landscape going forward?
Yeah, so you mentioned KRE with the massive drop, obviously in this past month, and kind of interesting. It of course becomes the newest by the dip candidate on the market, right? Picked up record inflows and pretty much doubled in size in last month alone. I don't know why we would expect anything less from the the ETF investing crowd these days. Um, but no, I mean, as far as how to think about it, I think it's going to be interesting to see how this affects, how the Fed and our monetary policy unfolds moving forward. They've kind of hinted, especially in the comments following their meeting last month, that, this sort of banking crisis might have done a little bit of their work for them, might give them the freedom to maybe relax on hiking interest rates. And it'll be fascinating to see, if we really do get a credit crunch where, a lot of these financial institutions are going to tighten up their lending standards, try to be a little bit more prudent with their investments, not only to regain the trust of a lot of depositors, but also because a lot of depositors have fled these smaller regional banks, and you don't have a surplus of deposits sitting in your coffers. It's a little bit harder to dish out loans to, even some of the more credit-worthy potential borrowers. So we'll see how much it tightens up, and what I'm really curious about is, to what degree it kind of reverberates through the stock market, and more specifically in the small cap market, right? We saw this past month alone, small cap stocks overall really took it on the chin. That's because, they're including a lot of those regional banks. Whereas large cap stocks, people kind of fled to for some of these big gargantuan companies with treasure troves of cash that can absorb those issues a little bit better, maybe aren't as reliant on banks to loan them money. So I think it's fair to be a little bit trepidatious of small cap stocks moving forward, just because they're maybe a little bit more sensitive to a potential credit crunch, and maybe start to look at something like a QUAL, a portfolio of stocks that have really healthy balance sheets, and might be a little bit better insulated from those concerns. But we'll see. We'll see. There's a lot that remains to be seen.
Because I remember last time we spoke last year, the small cap stocks were one of the names that you were paying particular attention to, correct?
Yeah, that's right. And I was thinking about that today too. Just because for a while, they've looked pretty attractive from a price multiple standpoint. And last year, I was expecting them to get hit a little bit worse than they actually did. So I was thinking potentially ripe for a rebound, but just given the fact that most of the regional banks reside in the small and mid cap sectors, that made for a really tough March for them. So they've been pretty far behind the larger cap, higher quality names in the first quarter here.
Yeah, it's definitely an interesting segment to watch. I also wanted to ask you about the tech stocks, which have been fascinating to me in terms of, the different kind of conflicting trends that we're seeing. On the one hand, a lot of the companies moving away from the metaverse, and then semiconductors seeing kind of becoming a haven in terms of performance and safety. Do you see how do you think about, the tech trend kind of going forward, or do you see more rebalancing happening in the ETFs in terms of how these, issuers and investors should be thinking about the tech sector going forward?
Yeah, it'll be interesting to monitor, and I think a lot of ETF investors are starting to pick up that appetite for tech ETFs again. We saw them pulling over $1 billion in March after kind of a slow start to the year and slow 2022. I mean, it's been a big 180 from last year, right? When you need to think about tech and growth stocks, I think, as being a lot more sensitive to interest rates than most, healthcare, utility, value-oriented stocks, because their forecasted cash flows come further in the future. So when rates go up, present value of those cash flows are a lot lower today. So we saw, growth stocks pretty much across the board, but none harder than tech, really get crushed last year. And I think early on in 2023, there's been a couple things working in their favor to sort of spur that turnaround. Number one, I hit on a little bit, is a lot of these tech companies, your Googles, your Microsofts, your Apples, that did really well in the first quarter, especially in March, tend to have really healthy balance sheets with a lot of cash. So should there be any sort of credit crunch, any difficulties in acquiring just lending, they're going to be pretty well positioned to handle some of that. They feel like a little bit of a safe haven in that regard. So I think it's fair to treat them with some respect in the first quarter, because they can handle it. And then on the other front, We're starting to see, from the Fed a little bit of that signal that these interest rate hikes might be drawing to a conclusion sometime soon. I believe the consensus forecast has only one more 25 basis point hike for the rest of the year, and then a pause or potentially even a cut later in the year and into 2024. I think the market last year was really kind of a one-trick pony, where it was whatever the Fed was saying was moving the market one way or the other. It's more nuanced this year now that we've got all these other factors, but still, the fact that the Fed, is potentially going to reduce those interest rates a little bit sooner than maybe some anticipated, as recently as 3 months ago, is working in tech's favor. You brought up the semiconductor stocks. I think that's certainly a big driver for them there. You've seen just tremendous rebounds from the likes of NVIDIA or Advanced Micro Devices have absolutely shot the lights out in 2023 here. So maybe there's a part of it too where investors thought, maybe we were a little too quick to write them off in 2022, a little too responsive to what the Fed was saying in the warnings they were issuing last year. So I think, that kind of constellation of some, behavioral stuff, some monetary policy, and the higher quality of some of their balance sheets have all kind of pushed them up. Whether that trend remains in place, it's difficult to say. As my small cap as the sector to watch call from last episode will tell you, maybe I'm not the one who should be looking into a crystal ball here.
That's a great breakdown, Ryan. Yeah, it's going to be interesting to see whether, tech can regain its leadership role that it had prior to 2022. Was 2022 just a one-off, or is what we're seeing this year kind of just a reflexive rebound after being beaten down so hard, and then they're just going to fall back down again? I think, it's really hard to say, given, like you said, it has a lot to do with interest rates, and that's related to inflation and the macro picture. So who knows? But so far, it seems like they're doing pretty well in 2023. I kind of want to shift gears now and talk about active ETFs, because I know you've written about these quite a bit. What's going on with those? And, what's your long-term view of active within the ETF space? Do you think it's going to take meaningful share away from passive?
Yeah, I mean, so active ETFs, really just started to burst on the scene after the passing of the ETF rule in 2019. And over the past year and a half or so, we've really started to see their footprint expand. Last year, they only represented about 5% of the ETF market, but pulled in 15% of the net flows. Fast forward to quarter one of this year, still only 5% of the market. They've got a big pie to cut into here, but picked up 30% of the first quarter inflows. So we're definitely starting to see that, even as active open-end mutual funds see outflows, there are inflows into active ETFs. I think there's appetite for not only for ETFs across the board for some of their structural benefits, and not only the index strategies that they traditionally harbor. So yeah, I would not be surprised in the slightest to see active ETFs continue to bite into that index fund market share. Been some interesting players, and I think the different firms that have really made out well from active ETF inflows kind of show that there's different ways to do it. JP Morgan is the headliner here, and their largest active ETF, JP Morgan Equity Premium Income. JEPI is a fund I've talked about quite a bit. I awarded it the unofficial 2022 ETF Flows Award. JP Morgan has yet to publicly accept that, but that's neither here nor there. But this is basically a covered call strategy, that has some long market exposure, but is selling call options to generate a little bit of income, provide a little bit of a floor on that portfolio. Pretty well positioned for the 2022 bear market and absolutely crushed it. So JP Morgan, has kind of made its bacon through some of those non-traditional strategies, and they have some short-term bond strategies as well. You look at shops like Dimensional Fund Advisors or Avantis. These are kind of situated in between active and true passive. That they unfurl systematic active equity approaches, kind of taking the market and tilting it towards the small value and high quality factors. And they've all made out really well so far this year as well. And then you look at someone like Capital Group, which is, a really well entrenched kind of traditional discretionary active stock picking equity manager. And they've kind of made the pivot into ETF starting in early 22 and have done well there as well. So point being, I think there's not one simple formula, for really planting your flag in the active ETF market. I think what we've seen so far has shown there's a lot of ways to do it. And I wouldn't be surprised to see that attract a lot of other firms, that are maybe not finding success in the open-end mutual funds that they once did.
That makes a ton of sense. And speaking of active, someone who likes to make a lot of active kind of stock picking calls is Jim Cramer. And I know you recently wrote about the Jim Cramer ETFs. Are these funds to be taken seriously, or are they kind of a joke?
I would lean toward the latter. The funds in question here are LGIM and SGIM, basically a long Cramer portfolio and a short Jim Cramer portfolio. At the time that I recorded a video on it, I think the short Jim Cramer portfolio had about 7 billion in assets. The long Jim only had about 200 million. So I think that tells you which side the public tends to land on. But basically, the premise of these portfolios is, technically they're actively managed, but Tuttle Capital Management, the ETF provider that issues them, basically has three managers kind of rotate, across responsibility. And I think they might have been on your podcast, actually, now that I'm thinking about it. But they basically sit and will monitor Jim Cramer's Twitter. They will watch Mad Money, and they'll watch him on the news in the morning, just kind of hawking any sort of news on which stocks he likes, which kind of stocks he doesn't like. And in the case of the short Jim Cramer portfolio, SGIM will do the exact opposite. So it is objectively funny. The Inverse Cramer Twitter account has been around for a while. I think it's hilarious. It's good humor. I think people like the kind of humility that it instills upon a talking head on TV. But from like a real investment perspective, I don't think anyone would treat it as a really strong approach to building a portfolio, right? Like Jim Cramer's up there talking about stocks that he finds interesting, that are flashing in the news cycle, kind of whatever whims he's feeling on a day-to-day basis. He's not out there, speaking with the intention of building a really well-constructed portfolio. They're also long short. So keep in mind that, should we enter a really strong bull market, these would trail by a wide margin. And they're also expensive. I think both charge 1.2%, where you can get, your basic, boring, broad stock market index funds for only a few basis points. So from a real investment perspective, no, I would not treat it as something that you should slot in a very serious brokerage or retirement portfolio. But, if you want to sprinkle a little bit from a fund money account just to kind of follow along and hop in on the joke, I'm not gonna fault you for that one bit.
Fair enough. Fair enough. Yeah. And if Jim Cramer is the equivalent of throwing darts at a dartboard, then this ETF's kind of the same, throwing darts at a dartboard or betting against the darts on the dartboard.
Right. I mean, it's like, what we'll see what happens. Maybe all along, Jim Cramer really is the biggest fraud of all time. And this Inverse Cramer portfolio absolutely knocks it out of the park. That'd be crazy, but not something you necessarily want to be banking on.
Yeah, exactly. And then it's like also the interpretation of what he's saying, right? There's no like objective measure of which one he's more bullish on.
Right.
It's crazy, but yeah, it is funny. Like you said, it's objectively funny. But before we let you go, Ryan, is there anything else you want to add? What are you looking forward to for the rest of the year in terms of ETFs?
Yeah, I mean, like we touched on it just recently here, but I'm curious to see how active ETFs continue to expand. I think it's a real change in a market that for so long has just been super down the middle of the fairway with your Vanguards and your iShares rolling out these plain Jane broadly diversified index funds. I think more often than not, kind of informed by the Morningstar active passive barometer, we tend to look at those strategies really favorably. So the fact that they've kind of continued to dominate the flows landscape is a good thing for investors because they're cheap. More often than not, they're well constructed, and there's something you can feel good about putting your money in. But that's not to say active strategies have no merit, right? There's a ton of good strategies out there. So I'm curious to see like where else we see some of these top-notch, Morningstar medalist rated active strategies start to penetrate the ETF market a little bit. And see if they can kind of grab some of that market share that for so long has been dominated by these plain Jane funds. And then aside from that, just coming off this first quarter, I'll be interested to see if we just have a general U.S. stock ETF rebound. I think, Sumit, you laid out really well the reasons for pessimism and the overall concerns of the U.S. market. And I think astutely pointed out a lot of times that's, if anything, a really good signal that it's time to buy. For so long, we've seen investors just miss time, when they should be adding and subtracting from their portfolios. So I know I'll be following closely to see if, that bears out once again this year.
And Ryan, I also wanted to ask you in terms of your thoughts on the issuer side of things, and if you're seeing kind of going forward, any of the big firms will continue to dominate the space, or are you seeing some of the smaller players that are picking up assets going forward is one of the trends and one of the issues I think that you've highlighted as well.
Sure. Yeah. So the ETF market as a whole is really top heavy when it comes to the ETF providers, right? So your big three are iShares, Vanguard, State Street. That I think they have close to about 70% of the market share. Mm-hmm. I need to pull that number up. So correct me if I'm wrong, but they're the ones who have for a long time dominated the space. And, Vanguard in particular over the past few years has continued to just pull in money quarter over quarter. Even, this most recent quarter, they led the way with $25 billion of inflows. I compare Vanguard investors to Chicago Cubs fans, where whether Cubs are winning 100 games or losing 100 games, rain or shine, there will be people in the seats drinking their beers and cheering the team on. That's how Vanguard investors are. When markets are up or down, they're going to be rolling money in, concerns aside. They're just this big machine. That said, in the first quarter, State Street and iShares both really struggled, finishing in outflows for both of them. For iShares, they've leaned really heavily on their government bond ETFs. Those have been excellent and really kind of kept them afloat where their stock ETFs have fallen out of favor. I think they felt the pain of investors' overall distaste for U.S. stock ETFs in the first quarter, probably more acutely than anyone. State Street, tends to cater a little bit more to the sort of trading audience. They've got great liquidity in a lot of their funds, especially SPY, the granddaddy of all ETFs. So it makes sense that they might ebb and flow a little bit quarter to quarter, but I think we're starting to see some different players enter the fray here. Schwab ETFs have a pretty strong lineup of well-constructed, sensible products that hit on different market segments. And we've seen them just slowly but surely start to pick up some market share. They picked up $11 billion in the first quarter. And then I mentioned earlier, some of those active ETF providers, I think could be really well positioned to start to bite into some of that share. Eric Balchunas of Bloomberg calls them the four horsemen of active ETFs, and JP Morgan, Avantis, Dimensional, and Capital Group. I think that's a pretty solid moniker. And those are the four that, have really benefited from this rise of active ETFs. We'll see if there can be some other contenders that join the party and start to chip away at the big dogs up top.
For sure. That's great. We covered a lot of ground there, even worked in Cubs analogy. So
I've got baseball fever.
That's right. Thank you so much for joining us, Ryan. It's always great to have you on. And to our listeners, you can get the replay of this conversation on your favorite podcast app. Just search for Exchange Traded Fridays and subscribe wherever you get your podcasts.